we are going to be talking about the life insurance contracts. In general, when you sign into an insurance contract, there are two types of benefit payment. Mainly, the payment will be made upon death, or the payment will be made upon survival. However, there's also contracts where it has both benefit payment, which is upon death and also upon survival. Now, we are going to look into general types of insurance contracts. Let's look at the first one first, which is whole life insurance. Under whole life insurance, when the policyholders enter into a policy, let's say they enter into a policy here at time 0, when the policyholder is age X, this is in years, any time in the future after the persons enter into the policy, if the persons die somewhere here, then he will always receive death benefits. So we don't know when a person will die, so I'll put it up until infinity. It can die in the next year, the next 2 years, 3 years, and so on. Now let's look at the next contract. The next contract will be term insurance. Under the whole life insurance, it covers the benefit for the policyholder until the persons die. But for the term insurance, it will cover only up until certain period. For examples, a person age X enter into a policy over here, entrance. Okay, and then this is years. And the policy is only workable for n years. Let's say it is a n year term insurance. So the benefit will only be paid if the persons die somewhere here, which is in between time 0 and time n. If the person survive this period and then die somewhere later in the future, that particular persons will never get the insurance benefit. I'll give you examples. For example, if you buy into an insurance contract for 5 years term, so within the 5 years, it doesn't matter what is your age. Let's say your age is right now X. Within the 5 years, if you die somewhere in between 0 and 5, then you will receive the benefit. But if die somewhere after 5 years, then no benefit. Next, let's move on to the third contract. The third contract is pure endowment. Pure endowment is complement of term insurance. Under the pure endowment, it says that if you buy into an insurance contract at time 0, similar timeline, and you are able to survive n years, then at the end of the n years, you will receive the benefit. However, if you die somewhere in between 0 and n, there will be no benefit payout. If we are using similar example as above, let's say now we switch, instead of term insurance, we switch it to pure endowment insurance. So example, buy into a 5 years pure endowment. So if die within the 5 years, let's say if die here, then no benefit. If you manage to survive the 5 years, then you will receive survival benefit. Okay, let's move to the next contract. Endowment insurance. Endowment insurance is a contract which combines the term insurance and pure endowment insurance. Let's say if a person age X, this is the entrance, enter into the policy at time 0, if the persons die within this year, then he still will receive the death benefit. And if the person survive these years, let's say survive, then he will receive the survival benefit. Combinations of these both, we call it endowment. Okay, that's all for the introductions of the insurance contract. Thank you.